Are you ready to supercharge your dividend income? In this video, we're pitting two heavyweights against each other, SCHD and S&P 500. SCHD flaunts a dividend yield of 3.7%, while the S&P 500 lags behind at 1.5%, but that's not all. We're diving deep into payout ratios to reveal which investment truly puts more cash in your pocket. Using the latest data from July of 2024, we'll arm you with the insights you need to make a game-changing decision. And here's the showstopper. Imagine your $100,000 investment in SCHD skyrocketing to a jaw-dropping $1,521,852 after 30 years. If you're serious about maximizing your portfolio's income potential, you can't afford to miss this. Stay tuned for the ultimate dividend showdown. In today's video, we're diving deep into an epic showdown between two top-tier investment options to help you make the smartest choice for your portfolio. Using fresh July 2024 data, we'll uncover the secrets behind which one delivers the highest returns and payout ratios. But here's where it gets thrilling. Imagine investing $100,000 today. We're about to reveal how one of these investments can skyrocket your annual dividend payments to over $298,000 after 30 years. That's right, your investment could be generating a substantial income stream, reshaping your financial future. Our promise to you, by the end of this video, you'll have the inside scoop on which investment can turn your money into a dividend powerhouse. We'll delve into the nitty-gritty details of dividend yields, payout ratios, and the long-term projections, providing you with the knowledge to make a game-changing decision. Stay tuned because what we're about to share could be the key to unlocking your financial freedom. If you're serious about maximizing your dividends income and making informed investment choices and decisions, this video is a must-watch. Don't miss out on the chance to transform your portfolio and secure a prosperous future. SCHD Schwab U.S. Dividend Equity ETF. Harry, an avid investor, has been looking into SCHD for his portfolio. SCHD is managed by Charles Schwab Investment Management and is designed to track the performance of the Dow Jones U.S. Dividend 100 Index. It comprises high dividend yielding U.S. stocks, making it an attractive option for income-focused investors like Harry. The ETF has been an impressive compound annual growth rate of 9.5% over the past decade. It boasts an expense ratio of 0.06%, which is significantly lower than many other dividend-focused ETFs, ensuring more of Harry's investment goes directly into growing his wealth. The current payout ratio for SCHD stands at 65%, meaning that 65% of the earnings from its underlying stocks are distributed as dividends. SCHD's portfolio includes top-performing companies like Johnson & Johnson, dividend yield of 2.7%, payout ratio of 44%, and a 5-year dividend growth rate of 6%. PepsiCo, dividend yield of 2.9%, payout ratio of 77%, and a 5-year dividend growth rate of 7.8%. Verizon Communications, dividend yield of 4.7%, payout ratio of 51%, and a 5-year dividend growth rate of 2.1%. Coca-Cola, dividend yield of 3.1%, payout ratio of 73%, and a 5-year dividend growth rate of 3.9%. Procter & Gamble, dividend yield of 2.5%, payout ratio of 61%, and a 5-year dividend growth rate of 5.7%. Let's analyze the potential outcomes for Harry if he holds SCHD for various time horizons. Suppose Harry invests $100,000 in SCHD. After 1 year, assuming a 3.7% dividend yield, Harry would receive approximately $3,700 in dividends. The investment value would increase to around $109,500, considering the CAGR of 9.5%. After 5 years, Harry's initial investment could grow to about $157,622. After these 5 years, he would have accumulated roughly $19,240 in dividend payments, given consistent yields and reinvestment. Holding SCHD for 10 years, Harry could see his investment grow to around $247,948. During this period, he would have earned about $44,400 in dividends, providing a substantial income stream alongside the capital appreciation. After 20 years, Harry's investment might reach an impressive $614,062. He would have received approximately $126,040 in total dividends, assuming the yield remains stable and he reinvests the dividends. Finally, if Harry holds SCHD for 30 years, his initial $100,000 investment could potentially skyrocket to $1,521,852. Over these 3 decades, Harry would have earned a staggering $298,000 in dividends. This scenario underscores the power of compounding and reinvesting dividends in a high-yield, low-expense ETF like SCHD. By choosing SCHD, Harry leverages the benefits of consistent dividend income, low fees, and solid growth potential. This ETF diversified portfolio and strong track record make it a robust choice for investors seeking to maximize both income and growth over the long term. S&P 500 Index. Harry has always been diversifying his investments. He is considering adding the S&P 500 index to his portfolio. The S&P 500 is a market cap weighted index of the 500 largest publicly traded companies in the U.S., and it is often viewed as a benchmark for the overall stock market. Managed by S&P Dow Jones Indices, this index includes a mix of companies from various sectors, providing broad market exposure. The S&P 500 has delivered a strong compound annual growth rate of approximately 10% over the past decade. It carries an expense ratio of around 0.03% for ETFs like SPDR, S&P 500, ETF Trust, making it a cost-effective investment option. The current payout ratio for S&P 500 stands at 35%, reflecting the diverse strategies of its constituted companies, many of which prioritize reinvestment for growth. Key companies in the S&P 500 include Apple Inc., dividend yield of 0.6%, payout ratio of 16%, and a 5-year dividend growth rate of 9.1%. Microsoft Corporation, dividend yield of 0.8%, payout ratio of 27%, and a 5-year dividend growth rate of 10.9%. Amazon Inc. does not currently pay dividends, focusing on reinvestment for growth. Alphabet Inc. does not pay dividends, prioritizing growth and reinvestment. Berkshire Hathaway Inc. does not pay dividends, reinvesting both profits into business for growth. Suppose Harry invests $100,000 in S&P 500 ETF. After 1 year, assuming a 1.5% dividend yield, Harry would receive approximately $1,500 in dividends. The investment value could grow to about $110,000 considering the CAGR of 10%. After 5 years, Harry's initial investment could grow to around $161,051. Over these 5 years, he would have accumulated roughly $7,732 in dividend payments, given consistent yields and reinvestments. Holding the S&P 500 for 10 years, Harry could see his investment grow to about $259,374. During this period, he would have earned approximately $17,501 in dividends, providing a reliable income stream alongside the capital appreciation. After 20 years, Harry's investment might reach an impressive $672,750. He would have received around $40,457 in total dividends, assuming the yield remains stable and he reinvests the dividends. Finally, if Harry holds the S&P 500 for 30 years, his initial $100,000 investment could potentially grow to $1,745,942. Over these 3 decades, Harry would have earned approximately $70,948 in dividends. This scenario highlights the benefit of long-term investing in diversified growth-oriented index like the S&P 500. By choosing the S&P 500, Harry gains exposure to a broad range of top-performing companies, benefiting from both capital appreciation and dividend income. The S&P 500's low expense ratio and solid growth history make it an attractive option for investors seeking a balanced mix of stability and growth potential over the long term. Risk and volatility. Risk and volatility of SCHD. Harry, while evaluating SCHD, must consider its risk and volatility. SCHD is known for its focus on high dividend-yielding U.S. stocks, which can provide stability, but is not without risks. SCHD's volatility measured by its beta typically ranges around 0.85. This indicates that while it is less volatile than the broader market, it can still experience significant fluctuations. For instance, during the COVID-19 pandemic in March of 2020, SCHD experienced a sharp decline of about 30%, mirroring the broader market's turmoil. However, its focus on dividend-paying companies provided a buffer, helping it recover more swiftly than many growth-focused ETFs. Another incident highlighting the SCHD's risk was the market correction in late 2018, where SCHD saw a decline of approximately 15%. Despite this, its lower beta helped it fare better than the overall market, which fell by about 20%. The CTF emphasis on companies with strong balance sheets and consistent dividend payments provided a cushion against severe market downturns. SCHD's sector concentration is another risk factor. It has significant exposure to sectors like consumer staples, healthcare, and financials, which can be both a strength and a vulnerability. For instance, regulatory changes or economic downturns disproportionately affecting these sectors could lead to underperformance. Current market conditions, such as rising interest rates and inflation concerns, also pose risks to SCHD. Dividend-paying stocks can be sensitive to interest rate hikes, as higher rates might make fixed income investments more attractive, potentially reducing the appeal of dividend stocks. While SCHD's focus on quality dividend-paying companies helps mitigate some risks, it remains exposed to broader economic and market fluctuations. Investors like Harry must weigh the stability of dividend income against the potential for market volatility. Understanding these risks is crucial for making informed investment decisions and managing expectations regarding short-term performance. Risk and volatility of S&P 500. The S&P 500, a benchmark index representing the 500 largest publicly traded companies in the U.S., is a staple in many investors' portfolio, including Harry's. However, it is essential to understand its risk and volatility profile to manage investment expectations. The S&P 500 has a beta of approximately 1.00, indicating that it tends to be moving in with the line of the broader market. This makes it susceptible to market-wide risks and economic events. During the financial crisis of 2008, the S&P 500 experienced a dramatic decline, about 37%, underscoring its exposure to systemic market risks. The recovery took several years, highlighting the potential for extended periods of volatility. More recently, COVID-19 pandemic in the early 2020 caused the S&P 500 to drop by nearly 34% in a matter of weeks. Although the index rebounded relatively quickly, driven by unprecedented fiscal and monetary support, the episode highlighted its vulnerability to global economic shocks. Sector concentration is another critical risk for the S&P 500 index. Technology, healthcare, and financials make up a significant portion of the index. For example, the tech sector, led by giants like Apple, Microsoft, and Amazon, has driven much of the S&P 500's performance over the past decade. However, this concentration means the index is particularly exposed to risks in these sectors. Regulatory changes, market fluctuations, or economic downturns affecting the companies of tech could disproportionately impact the index's performance. Current risks for the S&P 500 include inflationary pressures, potential interest rate hikes, and geopolitical tensions. Rising inflation can erode profit margins, while higher interest rates may lead to increased borrowing costs and reduce consumer spending, impacting corporate earnings. Despite these risks, the S&P 500's diversified nature provides a level of resilience. Its inclusion of companies from various sectors helps mitigate the impact of sector-specific downturns. However, investors like Harry must be prepared for periods of significant volatility and drawdowns, particularly during economic crises. Understanding the risk and volatility of the S&P 500 is crucial for investors seeking to balance growth potential with the ability to withstand market fluctuations. By maintaining a long-term perspective, Harry can better navigate the inherent risks associated with this broad market index. We have journeyed through a detailed analysis of two prominent investment options, exploring their dividend yields, payout ratios, growth rates, and the potential long-term impacts on your portfolio. By understanding the risks and volatility associated with each option, you can make a more informed decision to align with your financial goals. The importance of choosing the right investment cannot be overstated. Whether you're looking for higher immediate dividend income or a balanced approach to growth and stability, these insights provide a strong foundation for your investment strategy. Remember, investing is not just about the numbers, it's about understanding the dynamics that drive those numbers and how they fit into your overall financial plan. Now, it's your turn to take action. Assess your own investment goals and risk tolerance, dive deeper into the details of these options, and consider how they align with your long-term objectives. Whether you're aiming for substantial growth over the next 30 years or seeking consistent dividend payments, make sure your choices reflect your financial aspirations. If you found this analysis helpful, please give this video a thumbs up and subscribe to our channel for more in-depth financial insights. And don't forget to hit the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love to hear which investment options you're considering and why. Thank you for joining us on this journey to smarter investing. Stay tuned for more content designed to help you maximize your financial potential. Happy investing and see you in the next video.